Every day, millions of people tune in to financial networks, hoping a shouting guy in a suit will hand them the one stock tip that will change their life. We look at the frantic energy of the trading floor and assume these professionals possess a secret knowledge. But if you took a blindfolded chimpanzee, handed it a financial newspaper, and let it pick a stock portfolio by throwing darts at the pages, the results would be identical. The monkey's random picks would match the returns generated by the top experts on Wall Street. In his book, A Random Walk Down Wall Street, economist Burton G. Malkiel presents the mathematical evidence behind this claim. Malkiel uses the random walk to describe price movements. Imagine a person who has had far too much to drink walking down a street. You have no way to know if their next step will be left, right, or backward. Stock prices move with that same erratic unpredictability. What a stock did yesterday has no bearing on what it will do tomorrow. So when an expert points at a screen and promises the market is going up, they are simply guessing. They are selling you an illusion of control over a system ruled by chaos. Investors usually ignore this randomness by falling into two camps. Some study a company's physical assets to find its actual worth. Others fall for a psychological trap, believing a stock is worth whatever price they can convince someone else to pay for it. When crowds buy based on what others are doing, market bubbles inflate. In 16th century Holland, people traded their land and homes for a single tulip bulb. They ignored the bulb's actual worth because the crowd had lost its mind. This crowd mentality continues to drive markets today. You see it in the 1992 Indian stock market craze, where ACC cement prices rose without logic, and in the recent mania around crypto tokens like Dogecoin. People buy because the price is rising, hoping to find a greater fool to sell to. Treating the search for a greater fool as an investment strategy leads to ruin. When the crowd eventually runs out of money, the bubble bursts, leaving the last buyers holding worthless assets. To maintain the appearance of expertise, financial gurus rely on technical analysis. They study market charts, searching for repeating visual patterns, hiding within the random noise of price movements. Analysts talk about spotting a cup and handle or a head and shoulders pattern. They stare at jagged lines of historical data until they see the shape of a human head. But drawing shapes over old data offers zero predictive power. By the time an analyst identifies a pattern, the market has already moved on. Malkiel equates technical analysis to financial astrology. Finding shapes in past stock movements to predict the future is as effective as reading horoscopes to pick a winning lottery ticket. Fundamental analysis, studying balance sheets and profit margins, is at least based on real data, but it still relies on the past. Even the most detailed balance sheet cannot account for sudden government changes, natural disasters, or management fraud. This brings us to the efficient market hypothesis. The theory states that the stock market operates with such speed that it instantly absorbs all new information and adjusts prices on the spot. Suppose news breaks that a new Tata Motors car is a massive success. You might think it is time to log into your account and buy shares before the price jumps. But between the second that news hits the wire and the moment you unlock your phone, institutional algorithms have already executed thousands of trades. The entire market processes data in milliseconds. You cannot stay one step ahead of a global system. Whatever insight you think you have, the market knows it and has priced it in. This makes active stock picking a losing game for the retail investor. If chart patterns are useless and the market moves too fast to react, what should you do with your savings? The solution is to manage your risk. Modern portfolio theory suggests protecting your wealth through diversification. You spread your money across IT, pharma, and consumer goods, so a crash in one sector cannot wipe you out. Rather than buying hundreds of individual stocks, you can use a broad-based index fund. In India, a Nifty 50 index fund automatically distributes your money across the 50 largest and most stable companies in the country. The index is self-cleansing. If a company underperforms and its value shrinks, it is automatically removed from the top 50 and replaced by a growing competitor. You never have to lift a finger. By buying the entire haystack, you ensure you never miss the growth, bypassing the impossible search for a single needle. This approach also avoids the biggest hidden wealth killer in finance: active mutual fund fees. A manager running an active fund takes up to 2% of your money every year as a fee, regardless of whether they make you a profit. Over 20 years, that fee slices away a massive portion of your potential wealth. An index fund, however, charges almost nothing. Without those costs holding it back, your money grows into a much larger, uninterrupted pillar of wealth. Data shows that over a 15-year period, more than 90% of those expensive active fund managers failed to beat the simple Nifty 50 index. The math is against the day trader. Stop hunting for overnight gains. Mute the TV experts, close the charts, and set up a consistent monthly investment into a low-cost index fund. True wealth in the stock market belongs to those who accept their lack of control, let time do the work, and quietly allow compounding to turn them into millionaires.